Hi, everyone, and welcome to Macro and Global Liquidity Analysis, Gold, Silver, and Bitcoin Monthly Update for March 2024. We're putting this presentation together for our valued clients of the Ainslie Group, including Ainslie Bullion, Ainslie Crypto, and the Gold and Silver Standard. I'd like to start by welcoming Joe and Paul to the panel. How are you going today, team?
Very good, Chris.
Great, Chris. Thanks for having us again.
Yeah, good to have you back. Now, we got lots of great feedback last time. We've refined a little bit, but we're going with roughly the same sort of format this month to try and keep it consistent and go through all of that analysis in a sort of logical way. But just before we get started, I'll just quickly remind everyone that everything said and shown in this presentation is intended for general informational purposes, does not take into account your particular circumstances, objectives, or situations, is not financial advice, and you should always do your own research and consider obtaining independent advice before making any investment decisions. All right, so a little bit of an overview of where we're heading today with this presentation. Firstly, we'll do what we did last time, look at that big picture. Where are we in the global macro cycle? Then we'll narrow into where we are in the global liquidity cycle, because obviously our belief is that, and we'll show why we believe this, is that the global liquidity cycle drives that big picture global macro cycle. Then we look at the assets specifically and where they fit in the picture, and we'll end up with a bit of a trading plan to show everyone what they can do to take advantage of this themselves. So that's the format for today. Starting off that very big picture, where are we currently in the global macro cycle? So we start off by bringing up our chart that has become sort of our Bible that we keep coming back to give us the biggest picture view of what's going on. Joe, I might ask you first if you can maybe just explain for everyone again what this chart's about. And there has been a change this month, so what that change is about.
Yeah, so we've got the four different cycles. You can think of them as seasons if you wish. We're currently, if you look all the way over to the right, we've actually dipped back into mid-cycle, which is where we expect growth to continue. Just referencing the bust and the late cycle, if you think back to late 2021 and early 2022, that's when asset prices were booming. And obviously everyone's going to remember late 2022, where the market basically bottomed. So ever since then, we've been transitioning out. That was the point of maximum gain for risk assets. That's not to say we're late at the moment, but we're definitely starting to move into a point where the gains are going to be a little bit less than they were whereas if you'd gotten in the bust phase.
And Paul, I mean, you write the daily news frequently for Ainslie and putting out all this information. Is this consistent, what we're seeing here, that maybe we're starting to tick back up into that mid-cycle again with sort of the stuff you've been talking about in the news?
Yeah, I think so, Chris. It's, I think I said last time, bottoms are bumpy. So we've certainly seen that. And we're in, I guess, more extraordinary times at the moment. So as we're coming out of that, there are a number of factors at play at the moment, but definitely we seem to be heading into that mid-cycle. I think that little brief early cycle hiccup was exactly just that, and we're definitely into it now.
Yeah, and I mean, we talked about this last time, saying that probably those few greens there should have actually been blue in terms of the early cycle, because it was more of an early cycle type economy that we're in. But well, now we're starting to see much more evidence of that mid-cycle because things are much more mature, and that's just what happens over time as it passes through. We tend to look at US. Now, obviously, I make this point all the time. The US is not the globe, right? It's not global, but the US is a good way to think about what might be going on, because we can zoom in specifically on what's happening in their economy and to guide our view of what's happening in the macro picture. And we look at US growth as sort of backing up what we've seen in that chart. We've got here what we've looked at in the past. We just updated the charts ourselves here. The ISM Manufacturing Purchasing Managers Index, where that can be seen, the blue line, as effectively a proxy for growth in the US. And the 50 line is sort of the zero, if you'd like to think of it that way, is the halfway point, where below that 50 line is contracting economy and above the 50 line is where we start to see growth again. And our leading indicator is indicating that we probably have seen the bottoms in the growth sort of pulling back in the US. That probably is consistent with what we were just talking about. I'll go on to this next one and then ask you, Joe, what your thoughts are on this. But the next one is just leading out even a little bit further, the 3-month leading indicator, trying to sort of give that view even further into the future. It also looks like sort of really seen the bottom in this process. You've been looking at this quite closely, Joe. What's your take?
Yeah, so if you're looking at 50, anything under 50 as contraction, we've spent a significant time in contraction, which is why there's been a lot of recession calls. So I think it's 16 or 17 months now in contraction. We sort of thought we might be heading above it last month, back into expansion, but we've dipped back down. But from my perspective,
because that's this line here, isn't it? Like that, it crossed right back here, sort of, well over a year ago, late 22.
Yeah, that's right. So from looking forward and using that 3-month leading indicator, I expect it to we start to get back into expansion very soon. You look at, for example, which we'll talk about later in the debt situation, the $1.2 trillion bill that's just passed that's going to stimulate the US economy. So, if the government's fiscally throwing money at everything, how does that line stay below contraction?
Yeah, and then look, we saw, I think last night, the Dallas Fed came out with disappointing numbers, and they were forward looking as well. So that we're at that order stage where there was weakness. So that could indicate, that's one state, but it's certainly an indicator that it's still a rocky bottom. House prices came off last night as well. So it's still, and hence that green and blue that we just looked at. So it's stuttering. And I guess the key difference between that early cycle and mid cycle too is the inflation piece, and we're seeing quite conflicting metrics on that as well. And so we're just at a bit of a dicky point at this stage, but certainly the trend is there, right? You can see it before you. So we're going to have these dips because we've come out of such an extraordinary post-COVID hit in terms of the type of inflation that we had. And so I think we can't expect a smooth sort of rocket out of this.
And we'll start looking at the inflation, like the US inflation, as the other side of that story now. But I think what's really important that we need to remember through all of this is when we're trying to take advantage of this, we have to be forward-looking. So the question is not so much about where we are currently, but where we think we're going to be in the future. And I think that leads in really, or follows really well from what you were saying, Paul, about the fact that we do have a rocky bottom there, because that's completely fine as long as we expect on the other side of that it's going up. And I think from those ISM charts that we were looking at, the idea that they're going to stay down there seems, which is to Joe's point, right, seems a little bit unbelievable when you look at the pure amount of stimulus that we know is in the pipeline and coming ahead. Turning specifically to this inflation indicator here, Joe, maybe do you want to just explain what we're actually looking at?
Yeah, so the purple line is the actual inflation reported, and the yellow dotted line you've got there is your trueflation metric. So as a leading indicator, we've seen it. I think it's predicted fairly well where we're going to head. It's around 2 point. I think it's 2.4. Oh, no, it's a bit over 3. Sorry. However, based on where we are seasonality as well, we could expect that to flatline and even potentially tick up just based on where we are in terms of growth. And, once back to that, what we were just talking about before, $1.2 trillion in stimulus, that's not necessarily going to drive inflation into the ground either.
No. And just to clarify on this, when we talk about this, look at this lead indicator, it is showing in more real time what's going on, whereas the purple line is always lagged. The way that they calculate the inflation data is always behind almost by definition, and it's got a lot of lagging components in it. So I think we can look at this more as an indication of the potential for surprises to the downside on inflation. Maybe to your point that you were saying about inflation picking up from here, that can still happen, but it's probably telling us that at least over the next couple of months, it's not taking off like a rocket.
That's right. It includes shelter equivalent rent, which is an extremely lagging indicator, the most lagging of all indicators. So could absolutely see that continue down from here, with potential to turn up as we move more later into the cycles.
And not to be too cynical, the CPI is the metric that the government control in terms of how they control that basket. And the trueflation is probably a less biased view of where it's at. You could say that they need the figure to be a little higher for longer to justify the rates to try and flush this right out, because they know what's coming. We've just discussed what's coming in terms of the amount of stimulus that's going to be coming with an election year, with where we are in the cycle. I think that the figure is $1 trillion every 90 to 100 days is what's coming into the US. So that is inflationary, right? So they have to, for as long as they can, try and stick it out to get it down to their 2% target. So I think by keeping it up there, it justifies those rates with all the pain that comes with them. But I think they have an end game in mind.
Yeah, and that does make a lot of sense and is consistent with what we'll now move to talking about, which is the US government debt and yields. It's a massive problem we keep focusing on every month that we can't really see an answer to. But let's break it down again and see where we are. This white line is the US government debt. It just keeps going up and up. And, we've had, as you said before, Joe, we've had that new, or Paul, whoever, if you said it, about the new money coming in through the bill that was passed for the US. So still looking at the US as a sort of indicator for the rest of the world, but everywhere else is very similar. It's crazy. And then you compare that to what we're seeing with the interest rates. And the point we've been making for a long time is that if these rates remain high, the debt is so high that the interest on the debt becomes actually stimulatory. So it expands the debt further, which is a terrible situation that you don't want to be in. So mathematically, we would argue that this red line, which is the Fed funds rate, needs to come down. And we've even seen indications within the last week that the Fed is thinking about lowering that rate. They're certainly speaking in some of those terms, but how are they going to do that? If we zoom in a little bit closer, which is the same chart, just looking at it a little bit closer, we can see, we really haven't seen a big pullback in these yields. That they've just stayed very steady after we saw that sort of peak scare earlier sort of in this year and throughout last year. So it's not a great looking situation. What's your take on that, Paul?
Well, I think for a start, let's just look at that 34.5. That's effectively now 35.7, right? So and that $1.2 trillion bill that just got passed, miraculously at the 11th hour. Actually, it was after the 11th hour this time. They missed the deadline, but everyone's looking the other way. That, I think I read, gives them 75% of what they need for the next 6 months. So it's as extraordinary as the number is, it doesn't cut it for long. And as you say, that's got a cost, right? So you've got the Fed fund rate sitting there at 5%. That's an extraordinary. Well, it's $1.1 trillion in interest costs alone on that ever increasing trillion every 100-day sort of figure. So you've got that dynamic, and then you've got the bond market that's now still nonsensically underneath that as well. So we've still got these alligator jaws that we keep talking about. They always do shut, and when you zoom back out like you did in your previous chart, you can see the reversion that happens every single time, and it's normally late. So they will normally drop rates too late. And to my point earlier, is that's the path I think we're heading down. So we either see those bond yields rise, and then that's going to be, I think a market event of some sort, and not a nice one, or we see them as everyone is speculating and waiting on every word that they utter. Is to when are they going to start dropping, and that they're down to only 3 now, right? So that's all forward looking and partly jawboning, but they're holding out longer than people expected.
Joe, what happens if this gets out of control? We've talked about it before, but I just want your take on this. Do the yields go up because there's a big issuance that just fails, or people just demand higher rates? I can't figure out how this unfolds.
I've changed my thoughts a little bit on it. I think the real risk is if and when, or if we get another bout of inflation, that's really going to hammer the bond market. If we get another bout of inflation, we're going to see bonds get absolutely hammered.
And just to clarify, what does that mean for this chart if bonds get hammered?
So as those lines move up, your investors expect a higher yield, which means a lower bond price.
So bonds getting hammered means this line will shoot up.
That means that will shoot up. Yeah.
Yeah.
So, like we're talking about inflation a couple of slides back, the Fed really need the cover, as in low inflation, to be cutting rates. Historically, that's through job losses. Inflation's never really been an issue before, so it's usually just employment that would allow them and slow GDP to allow them to cut. So really, I think that's what they're hanging out for. Even though we've got an extremely dovish press conference from Powell over last week, I think he's really just dragging it out as long as he can before he's forced to cut rates. Because as to Paul's point, the debt, just the interest on the debt, is what's driving that white line up $1 trillion every 90 days.
Yes.
Or portion of it. You know, you've obviously got social security and defense, but you know, debt repayments are a huge part of that.
Yeah, debt repayments are literally bigger than defense at the moment, which is quite extraordinary.
That's right.
And it's worth looking at the left-hand side too, Chris, because I've just seen, you know, the 2-year bonds is sitting at 4.59%. That's above the 20-year, the 30-year with all that risk premium. And then you've got the 5-year at just 4.19. So the market's expecting a bit of action over these next few years, and it would indicate, you know, it's betting to the lower side in the short term.
Absolutely, and I would argue too that these lines are a mess, where traditionally they followed. Yeah, we talk about it. That's what a normal yield curve looks like, where they're all in order, and it's been a mess for a while now, where they're all jumbled, and that's really reflective of central banks and governments playing games as well, right? Like they're not issuing what they would normally issue. They're playing around with the market, and when you play around with the market, it all gets jumbled and looks messy. But generally, when you play around with those free markets, it doesn't end well. So there's a warning there, I think.
Yep.
All right, so that's our big picture view of the macro economy. I think we've covered that fairly well. Then we go in specifically look at the global liquidity cycle. Now, the global liquidity cycle, we had a few questions on this, and we always get questions on this, and that's actually great to really look at why we look at the global liquidity, what the global liquidity cycle is. And I just wanted to add this slide in here, which comes from the work from Cross Border Capital, talking about specifically what global liquidity is and where people usually get it wrong. And this is really important for us because a lot of people talk about global liquidity, and it even says here they often incorrectly term global liquidity just made up of what world central banks have on their balance sheets. So that all gets a bit technical, but if you think about it just in terms of the central banks, people use a formula where they just add up 4 or 5 of the biggest, so the US, Japan, China, you know, they just add them up and say that's our global liquidity. This chart is really powerful, I think, because it shows that if you do that, this equates for just 12% of the true size of what actually constitutes global liquidity. So it can get quite technical to go into the definition of what it all means. But if you think of it as how much money there is in the world, that's the simple explanation. That the slightly more complex explanation is it's actually the capacity of balance sheets within the world. So if you think about yourself as an individual, what your personal balance sheet capacity is, that's sort of saying how much you could borrow, how much cash you've got. All that combined together dictates your liquidity, or how quickly you could access money and do something with that money. When you think about that at a global scale, it's kind of the same thing. What capacity you have, how much your assets worth, all of that comes into play, but particularly those assets that are really accessible nice and quickly. So things like bonds. So yeah, just really important, I think, to start off to just get that big picture overview that global liquidity is a little bit more than what people often think it is, but it actually becomes quite important for this next slide, which highlights.
And Chris, it's probably worth pointing out in that previous slide too, the fixation, and we talk about central banks, and I think that's giving the major 4 or 5, but the fixation on the Fed is not so much about the black. It's about how they more broadly control that with interest rates, and so that increasing and decreasing of global liquidity has many levers. So it's got the interest rates, it's got when they tighten, so when they're reducing that black line with quantitative tightening, So they've got, and then the reverse repo market, they've got a number of tools in their kit. So yes, the central banks are the puppet masters of this, but it's not just the fixation of what's sitting on their balance sheet.
And it's actually, I'm glad you've raised that, because it's an important point to make about that it doesn't always work, right? Like, and increasingly the concern is that central banks have actually lost control of a lot of this, because when you actually look at the chart and see how much is not in their control, other things can be happening outside of that that really keep liquidity flowing or pull liquidity back that's outside of their direct control. So you're absolutely right. So much focus is on the central banks, but in reality, there's a lot else in the private sector or the whole shadow monetary base that's going on that is not just as simple as what's happening with interest rates right now. Really important point. This chart I love to just keep bringing up because it highlights why we look at global liquidity, because the correlation is undeniable when you use some causality tests, basically saying, does global liquidity cause world financial asset prices to rise and fall, or is it the other way around? Do world financial asset prices change global liquidity? And when you look at that question, it is proven beyond any form of doubt that it is global liquidity that is driving financial asset prices, not the other way around. So it becomes, and the correlation is so high that it becomes undeniable. It's something that you really need to be paying attention to. And the argument is that it's increasingly something that you have to pay attention to because of the debt situation, which we just highlighted before. As we continue down this path where fiat money really is the root cause of all this, where you've got so much money in the system and so much correlation between assets moving depending on what that money is doing, you really have to be paying attention to the underlying drivers of that, which is what we are doing here with global liquidity. So we look at this chart every month, the index itself, which is sort of a compilation, if you like, of all the elements of global liquidity and indexing it between 0 and 100, so we can see, relatively speaking, are we high or are we low? And this can be a little bit confusing because when we look a bit later at the specific numbers for global liquidity, they're going up, but the index might be not following that exactly because there's other factors at play. But Joe, maybe do you want to just start us off a little bit here about what the power of this index is doing when you look at it over this time period on the chart that we can see here?
Yeah, so in the next chart, we're going to go through a sine wave with correlation to liquidity. And you can see that it's the ebbs and flows of global liquidity all move together. And that's really just a symptom of, particularly over the last 10 years since central banks reset their interest rates down to 0, effectively a debt jubilee. If you're not paying interest on the debt, then there's no actual debt to worry about. So yeah, if you just look back to that last chart, Chris.
So this chart here, just because you jumped forward on that and thinking of is just saying that correlation has existed for a long time, right? Like that's really all this is pointing out. But this here is giving us some of the specifics.
Yeah, that's right. So we've actually dipped below. We were at 40 last month on that index, so we've actually dipped below, which is now we won't actually trade that. It's just a precursor to say we may have a bit of a rocky period through the next month until we get the next data that comes out. So we may see that in risk assets, particularly the Nasdaq, S&P, Bitcoin. I think Bitcoin's going fairly well at the moment, so it might be kicking that off. But but the point is from here is we expect that index to continue rising throughout 2024 and into 2025, which is a risk-on environment for assets.
It's worth, before we leave this chart too, it's worth just noting those two text boxes, right? So up the top, you've got asset price booms, and then the bottom, it's a generalization, but it's an oft repeated one is banking crises. So really, this is the oil in the engine, and when all the oil's up the top, lubing up those growth assets, the gears the gears can grind pretty dry in the banking system. So we see that reasonably predictable, growth assets booming at the top, and then the banks failing thereafter.
And the most recent example of this was what happened last year with that the US regional banking crisis, and we could see that we actually were talking about it before it happened. We didn't know what it would be, but we knew something was coming because the liquidity just wasn't there that was necessary to keep the system functioning as needed. The oil of the system is the perfect example or description, because that's what happened. We could see we're coming into some sort of crisis. We don't know what it will be. And sure enough, something happened, and it was exactly where we expected. It was a banking crisis, very specifically in those regional banks. We could argue we're not really even out of that yet, because similar to the ISM, as we talked about before, this 50 level in the middle is actually where we're really expanding global liquidity. So at the moment, even though we're heading in the right direction, that's actually telling us when it's below 50 that we're reducing the level of contraction, if that makes sense. We're not actually into that expansionary phase yet. The market's forward looking, of course, do their job and see that we're heading in that direction and start moving ahead of the actual move in liquidity. But we're certainly not there with pumping liquidity yet, and we're certainly nowhere near where we were at the end of the last cycle. So that's all still ahead of us, and that very much drives our discussion on all of this.
And to join those dots too, again, going back to that bond yield chart, is that last banking crisis was because yields went up, so we talked about those alligator jaws, those yields going up in all those bonds meant the bonds were dropping. So the mark-to-market losses with these banks holding those bonds saw their collateral, disappear. So again, when we go back to that global liquidity index and we see how all this plays out in terms of what that accessible capital is, when those bonds fell like they did, all of a sudden the collateral for the banks fell with it.
And they fixed that by implementing the bank term funding program, which injected huge amounts of liquidity in the system, so that liquidity for the bank, not for everyone else, but that's how liquidity is measured as well. So,
and that finished a couple of weeks ago, and that's part of this rocky road I'm talking about.
And that's right, and that reflects in that little dip that we're getting, because one of those major sources of liquidity, and US isn't the world, but it's a big part of the world when it comes to what was happening through that program and the liquidity that provided. We can see that. I know we always love looking at this particular chart. We can see it here with the green areas indicating what we had back in 2021, sort of coming out of COVID, where we had the massive liquidity injections into the system. Down the side, we have all the countries of the world, and the more green you see, the more countries that are injecting. Here was the contraction going on that we went through when you looked at the ups and the downs of that cycle, and we're clearly starting to see green coming back in to the heat map again here. So it's the same chart, just in a different way of visualizing it, but I think it makes it quite clear that you wouldn't expect, looking at that chart, that we're heading straight back into another red. You would expect that we're going to see a lot more green ahead. So that's a lot of what drives our confidence that we're not at the end of this cycle yet. I want to move on to this next chart. This is a new one that we've only started looking at over this last month, which is the weekly global liquidity. Now, this is really interesting because this is the raw numbers. So when I talked about the index being between 0 and 100, this is the number in straight up US dollar terms in trillions of dollars. And we've just broken above $171 trillion of global liquidity. And we can see it's actually been nudging higher ever so slightly every week since. I find this chart quite interesting because if you look back, and this is sort of only going back over the last sort of 12 months, but if you look at what's happened recently, it seems quite flat. Do you have any sort of perspective on that? Maybe, Joe, do you have any reason why you think that might be sort of just flattening out there?
Well, it makes sense, I suppose, when you look at that sine wave where we've had the pullback in liquidity. I'm sure there's a lot of different metrics that go into creating this chart, and the scale is probably a little bit different from our sine wave as well. So whilst it's flat, I actually love this chart. Actually gets me quite excited when you overlay it with that sine wave and what you expect to happen in the future. In terms of asset prices, this chart makes perfect sense. All-time high in nominal liquidity in $170 trillion. And we're an all-time high in the NASDAQ and S&P. So no one can really argue that global liquidity has no impact on asset prices.
In terms of that trajectory as well, like if you look back when everyone was again fixated on the Fed and they were quantitative tightening, they had their rates jacked right up, but yet somehow the liquidity is still going up. It's because China was printing hand over fist, Japan was printing hand over fist. And then what we've seen more recently is Japan, just for the first time in decades, has tightened, God forbid, to zero. So from negative one to
tightening, but still from where it was, yes.
Yep, but it is tightening, right? The PBOC, so the People's Bank of China, they eased back on that quite prolific liquidity injection too, because they started seeing their yuan get damaged in the process. So we are seeing some big players pull back a bit, but it's coinciding with and that BTFP that we just talked about. So that's ended from the Fed's point of view, but still up and to the right, there are still plenty of new liquidity coming into the system.
And I think if we look, this is another chart we like to look at, which shows similar picture zoomed out, because this is actually using those numbers as well, the actual dollar figures. So you can see liquidity, just the black line just going up and up and up over time. But it adds a few other elements, which starts to bring us in to what we'll talk about shortly, which is those specific assets to take advantage of this. But this is a chart we've really focused a lot on recently, where you can see at play, particularly this dotted line down here of CPI inflation or consumer price inflation versus asset price inflation, which is a really important distinction to make, that liquidity doesn't just impact the prices of goods at the shop, which everyone feels. It also impacts the prices of assets, which is why we've had massive problems over the last few years with people, first home buyers, for example, not being able to afford a home, or people looking at share markets that they've missed out on following because they're expecting a pullback that just didn't come, because there seemed to be for some reason, the prices just kept going up. There seemed to be an unlimited supply of money coming in. Well, we can actually explain where that unlimited supply of money was coming from. It was being printed effectively. It was central bank or government money that's being pushed into the system through liquidity. But do you want to maybe, I think, Paul, maybe talk about this one? And then we have another chart as well, which is really interesting, that really highlights the wealth gap. So do you want to maybe start by talking a little bit about what's going on here, and then we'll look at that other chart as well?
Yeah, sure. Look, and we went through this last month, but it's worth repeating. There's a misconception that when people talk about gold as an inflationary hedge, people too often are thinking CPI inflation. So, consumer inflation, Main Street inflation. That's the least of your worries, because what gold is actually doing a beautiful job of, and now crypto joining it, is actually protecting you against the monetary inflation. And this chart, not coincidentally, starts in 1973 when we actually saw us leave the gold standard,
yes.
And then thereafter out came the credit. So what gold and Bitcoin are really doing is protecting you from that monetary inflation. Your wage is only going up by CPI. You're just so, and then it's sort of the segue to the next chart is what that means is if you're not in that game, then you're just getting left behind. And this is a chart from the very Federal Reserve themselves that shows you, and I'm not sure about the colours for everyone, but those top two lines are effectively the total net wealth held by the top 0.1%, right? And the other line up there is M2, which is too often a measure of liquidity. With the global liquidity we talk to is a far, far broader metric. But if you want to dumb it down to just M2, so just monetary supply in the US, check that out for a correlation. So
unbelievable, isn't it?
So all the assets that top 0.1% own, so that with their big gold portfolios, share portfolios, property portfolios, in terms of assets, that's what they're tracking it. For that line right down the bottom.
This is everyone else.
Yep. Well, it's the bottom 50%. Okay, so you look at the wealth held by 0.1 and compare that to 50% of that whole 350 million people, and that tells the whole story of being in line with that CPI figure as opposed to the monetary inflation figure.
And it also tells the story of why people are so angry, right? Like this is, they may not be able to see it. And I think that's a really important distinction between asset price inflation and consumer price inflation. Everyone was up in arms about consumer price inflation, but now that's started to pull back. People are still angry and they don't know why. With consumer price inflation, you do know why, because when you go to the store and your bananas cost 3 times what they cost you last year, you can see that, and that it flows through to your day-to-day, and you get angry about it. You can't necessarily see this happening as clearly, because it's often seen in a different way. This is the point I make, is that you look at your property price going up, everyone pats you on the back. It's a positive thing. Oh yeah, great property, it keeps going up. That's great. But when you go to buy it, you can't afford it. It's seen as a negative. But it's not like that. Everyone's unhappy about the bananas.
Yep.
Not everyone's unhappy about the property price going up or your shares or any of those other things. In fact, almost everyone, it's very hard to find anyone who's not happy about the share price going up, but it's actually the same factor at play.
Yeah, it's another, and also that when you project up from 2020, just the eye-watering exponential growth of monetary supply, COVID. I think all up, 40% of all the US dollars that were ever created were created in that 2 years.
And it makes sense, right?
Mind-boggling.
Yeah.
It makes sense when you think about the trickle-down effect of money. The top percentile always going to have access to the credit to buy assets first, and then as money is spent to the economy, the people in the lower percentiles get to have whatever's left. So it just goes to show that the rich continue to accumulate assets, and to get out of that cycle, you need to start accumulating assets yourself.
And that's a perfect segue to where we're going next with this, which is how we take advantage of this through the correct assets. And we term this macro assets for macro cycles, because some assets are better than others for taking advantage. We said everything really goes up. All of those financial assets go up over that time, but there's not necessarily the same correlation between all those assets. Some of them just tread water. Some of them lose water compared to what's happening in terms of asset price inflation in particular over time. But specifically what we look at, gold, silver, Bitcoin, there's at least an attempt from those assets, because that's kind of their whole job, to maintain purchasing power against the debasement of the currency, which is what's the flip side of all that inflation. They do their job. Bitcoin particularly, which we'll look at, outperforms that. But let's start with gold. It's been reaching all-time highs recently, certainly being very exciting here at Ainslie, where we've seen people who have been waiting for this for many years, because it's been actually a very long, a decade-long sort of cup and handle pattern that when you look at the chart, zoomed out even further than what we show here today. But it's been this long pattern. It's starting to break out now, a very exciting time for gold. But if we sort of zoom in and look at the liquidity, particularly recently, and I'll just highlight on all these charts, the line, so this yellow line here is the price of gold. It's actually the average price for the month in US dollars. So it reflects up to the March chart here, reflects the price up to the end of February, so that we can correlate that to what's going on with the underlying Global Liquidity Index. We've seen this here really not a pull-off. It's actually remained remarkably strong throughout this whole period of time, even though we've seen liquidity pull back a little bit. What would you say is going on with the gold market at the moment that's causing, first of all, these new all-time highs, Paul, but also its stability up and maintaining those highs?
Yeah, and I guess if you look at it today, it's at 2170, so up around the.
So we're even a bit higher than this.
Yeah,
I'm going to have to rescale my chart next month.
Up around our silver standard icon up there. And look, and that's been driven by people looking through this, so they can see what's coming, and we are, and it sounds, anyway, we're in a rare each way bet at the moment, because some of that choppiness is this unknown around inflation, right? So if we actually see counter to what we're suggesting in terms of being in that mid-cycle, so if we're actually seeing rising growth and rising inflation. But if we're seeing falling growth and rising inflation, that's stagflation. And so when people are looking, well, we could go either way here. Well, gold loves stagflation because your real interest rates are low, and that's gold's sweet spot. And then you've got what we've shown quite clearly in what you're looking at right now, is that correlation with the liquidity index. So if we do see that continual increase in liquidity as the cycle dictates, we almost certainly are, then gold benefits from that. So we've seen huge buying up from central banks. We've seen huge buying up from China. The ETFs, I think, are still bleeding a little, and that's just that traditional play from Wall Street. But
although I was looking at that, some commentary around that saying that they were bleeding, yes, but it's going straight into the hands of central banks. It's not bleeding out into the market, and that's why it's not impacting the price.
Yeah. Price is the ultimate, arbiter, right? So it's telling us that demand is outstripping supply, and so whilst the ETFs might be coughing up a bit, it's getting gobbled up by central banks, by China and others. So people are looking through this little hiccup in the Global Liquidity Index, and if it does continue, they're actually seeing the other side of the equation of the safe haven play for gold.
And some other analysis I've seen this month has talked about the sentiment around gold and silver as well, just really not reflecting the high prices, and that's extremely bullish. So for those who aren't familiar with how sentiment works in terms of using sentiment as part of a trading as a trading tool, you often look for the opposite, right? So you want to buy something when it's most hated, and you want to be selling it when everyone's on board and loving it. And gold and silver at the moment are not anywhere near the highs of their sentiment ranges. They're still very much underloved in the market, particularly from retail investors who tend to be the ones to get it most wrong in these cycles. And it's just really very, very bullish signs that we can be at the all-time highs and maintaining those all-time highs, and everyone's still hating it. I mean, this is when you should be loving it most, right? When it's made you this money, but people aren't there yet. So that's pretty encouraging.
Yeah, definitely.
We'll move on. We've mentioned silver a little bit, so same sort of thing. I look at silver and go, when we look at these longer term cycles, that it consistently lags. We've talked about this before and we've seen it. I think we can even see it now, where we had this was out of sort of that COVID period where we had that massive rally in silver, but silver is nowhere near its all-time highs. So beyond this chart, the all-time highs are still much higher than what we can see here. Silver's nowhere near that yet. And we've had, again, it's sort of probably more accurately reflecting what's going on here. But do you think that leads us to an eventual catch-up cycle from silver, if particularly if gold takes off from here, Paul?
Yeah. And look, as we're sitting now, it's 24.70, so it's up certainly up from where it is, albeit that these are monthly averages. But that gold silver ratio is definitely, so it's down to 85, I think, at the moment. So
I'm actually going to chop to that one, because I think this actually reflects it best. So the gold silver ratio, we've got the longer term one there, which you're going to have a look at, but specifically this chart, the gold silver ratio here, even at the end of the month, on the average, was still sort of up above in that 90 range. It's right up there, isn't it?
Yeah, absolutely. And that's the enticing setup, because we're really only seeing gold getting momentum of late, just breaking through the all-time highs. Silver always lags, so it'll wait for gold to get that momentum. Will come in later in the cycle, and that's where silver almost predictably just goes and overshoots gold every time.
And we were looking at this before, and a comment that popped into my head was, in some ways, we've been a little bit warped. Our perceptions have been a little bit warped by just what happened in that COVID period, where the gold ratio just went, the gold part of the gold silver ratio was so high, like just ridiculously high. And then obviously we got that big catch up of silver that it played later in the cycle. But we actually have become a little bit numb to how large these numbers are historically on the GSR, because when we're looking at numbers at 90, if we didn't have this big spike, so if you sort of block that out of your mind for a moment, we would normally look at a number around 90 as being quite a high GSR historical rate. And now we're sort of like, I can still go higher, but maybe you can't. We might be approaching that time where it is actually, we have to acknowledge it is actually a large number.
Yeah, and it's all relative too, right? So that 120 certainly looks like an outlier. But when silver went on that delightful run in 2021, look at where the gold silver ratio finished. It was still in the sort of mid 60s.
Yes.
In 2011, when silver hit $50, it was 30. So we went from 120 to mid 60s. If we go from 90 back to 30, there's going to be some very big smiles on the faces of a lot of Ainslie customers, because that's just an extraordinary multiplier for the silver price. So absolutely, if you took that 120 out of the equation, 90 is historically very high. So we're still at that highly undervalued compared to gold stage, and I don't think there's anyone. So there's two sides to every equation, and I don't think anyone is saying that gold's overvalued at the moment. So we're early cycle. We've seen the charts where we're at. This is still early cycle. So in the coming months, that's when we can start to see silver do what silver does.
Absolutely. And I think one last point on this chart, we're not saying that the correlation is quite the same on this chart to the liquidity. It's more that silver tends to make its big move, and the big move for silver is actually this chart falling later in the cycle. So we may not be there yet, but also the problem is when it makes its move, it's often very quick, and you don't really want to miss it. So with silver, you'd rather be a little bit early than trying to chase that when it's starting to play that catch up, because we just see historically some very explosive moves there. So, all right, moving on, Joe. This is your time to shine. The area you're constantly focused on, Bitcoin. Now we start off. We just really highlight this chart to just say Bitcoin is probably the most correlated asset on the face of the planet to global liquidity. We've seen really very, very strong correlation statistics around that. And looking recently, so I mean, you can zoom out and look at the bigger picture. It really has lined up, particularly at the bottoms. We've just had these perfect over the last two cycles, perfect bottoming of the liquidity cycle lining up 1-to-1 with the bottom of the Bitcoin cycle. But this chart, obviously, we're at 50. This is pointing at about 50,000, and we're $20,000 higher than that at the moment. But lined up really well. It hasn't really stopped here, despite what we've seen in that pullback in liquidity conditions recently. What's going on with Bitcoin?
Well, I think we need to remember that Bitcoin's price action is obviously centered around liquidity, but it's also a secular adoption trend as well. So whilst we are getting, and we said this ourselves, we expect a little bit of a rough couple of weeks with that liquidity pullback. We've said that recently. We've actually had that bit of a pullback, and now we're starting to inch our way back up to all-time highs. But in saying that, it doesn't necessarily mean that we stay range bound for a long period of time, and that we can't break to new highs. Because we're looking, like I said, secular trend adoption, ETF buying. We're back into positive inflows this week after 5 days of outflows last week from the GBTC selling, which is the largest ETF that had a lot of outflows for various reasons. So in the face of this dip in liquidity, Bitcoin's, in my mind, has reacted quite well.
Yeah, absolutely. And I think what we might be seeing with Bitcoin is it looking through to the other side a little bit faster than those other markets are. Obviously a wobble that we're expecting over, really, because I mean, we're really expecting that wobble over most of April as well, and possibly even a little bit longer. And it's probably just looking through it at the end of the day, because it tends to do that.
Particularly if you're referencing back to that mid-cycle where we are, mid-cycle crypto summer, we expect, whilst we've had excellent gains over the last 18 months, we do expect that over the next 12 months, well into 2025, that we will, as liquidity continues to grow and the debt burden grows the debt burden on governments continues to grow, we expect liquidity to grow and Bitcoin to continue performing very well.
And I just encourage... Sorry, Paul.
As you said, Joe, too, there's other drivers in terms of, so with that 4-year cycle, pretty much every single time before a halving, we get this kind of pullback, and we've had it. And today and yesterday, the inevitable bounce out of that, maybe.
17.7% pullback. It's actually not that bad. It might have felt rough, but it wasn't.
But predictable.
Historically
you look at charts of every single halving, and the halving's next month. So it's fairly predictable.
Exactly.
And I just encourage anyone, if you want that deeper dive specifically on Bitcoin, we did, I think last week we looked at that, and you can find that in that research channel, our Beyond the Block series, which specifically focuses on Bitcoin. So there's a lot of deeper dive on that there that you can find. This monthly macro and global liquidity analysis is brought to you by the Ainslie Group, Australia's trusted choice to buy gold, silver, platinum, and crypto online or in our Brisbane and Melbourne showrooms. With over 50 years of operation, we're your reliable partner in wealth management. If you're looking to buy tokenized gold or silver anywhere in the world, check out the Gold and Silver Standard for the security of real-world assets, precious metals particularly, combined with the flexibility of blockchain. All right, so we like to provide a little bit of extra value to the people watching with our specific or a specific trading plan that they could use to take advantage of cycles. I know a number of us around the office, we are following this pretty closely, and it's really very, very simple, this trading plan. It's that we look for the index to find a bottom. So we look to find where we are in the index, first of all, and then when we build conviction that the low of the global liquidity cycle's in, that's when we make our Bitcoin purchase on a buy signal. We hold that until the sell signal when conviction's built that we've sort of passed that high in the global liquidity cycle, which we'd say we're nowhere near yet. Looking at the chart, this data is as of today. We had that global liquidity cycle low back in October. Our buy on the 10th of January 2023, being just an absolutely spectacular trade since then. And as we've argued throughout all this, we don't think we're anywhere near the end of that trade yet, not close to that sell signal. But so far, those results are pretty spectacular. So the current gain is 300% over 441 days. That was as at today's open. And if you annualize that, that's nearly at 250%. So really quite spectacular gains. Any comments on the price of what we've been seeing in the Bitcoin market on this chart that either of you would like to add?
I'd just like to say that, yeah, like I stated before, there's still opportunity to make reasonably good gains in Bitcoin itself, purely based on our liquidity and where we are in the market cycle. So even though we're close to all-time high, once we blow through that, that's when you move into the speculation phase. And most people are usually pretty amazed at how quickly the gains are made during a very short period of time.
Yeah, it's the same for gold and silver. I think people see an all-time high, and the human instinct is sell, right? It's
yes.
But go back to that chart where we showed that black line up and to the right, up and to the right, up and to the right, and gold and Bitcoin following them like this along the way, right? So we're going to have the all-time high becomes just the base of the next cycle. So we've just got to put it into context and not have this automatic reaction that sell on all-time high.
And it catches a lot of people out, particularly if they've been holding for a long time. If they bought in at the last all-time high, they've been holding for a long time to get there again, they immediately sell before they even realize any profit. They're just like, I want to be out of it. And then inevitably they'll end up buying back in at the next all-time high, because then they'll start getting the FOMO again and won't want to miss out. Yeah, it's it's a repeatable pattern, that's for sure.
Yeah, 100%. There's nothing more certain.
Hopefully people watching this will not make those same mistakes. Okay, well, that's it for this month. So thanks for watching our update. Any final comments, Joe or Paul, that you want to leave our audience with?
I'll just say, we're really in terms of someone who owns Bitcoin and gold myself, I'm quite looking forward to the next 12 months in terms of price action. We've already broken through all-time highs in gold and Bitcoin, and yeah, just really looking forward to seeing how the market plays out and watching the gains come through.
Absolutely, Paul.
Yeah, no, absolutely. I can't add any more to that. We're in for a very interesting year with a big smile on my face.
Yeah, we have a lot of big smiles on our face around here with the action at the moment. So, well, thanks again, Joe and Paul, for all your work on that today. Personally, I always value any feedback and discussion. So follow me on X at Tipper Analytics to stay up to date, or reach out if you have any questions or comments. Reach out with those. I'll definitely make sure that we answer them. We'll be back in April with the next monthly update to reassess and identify what has changed. Until we chat again, good luck in the markets.
Yes.